Welcome back to the deep dive. We cut through the noise, the density of recent research, really distilling complex analysis into, well, pure actionable insight. Today, we are tearing into a really big fundamental deep dive on Verizon Communications. That's ticker VZ. Okay, let's unpack this a bit. The analysis we're looking at is dated October 11, 2025. Back then, Verizon was trading right around $39.85 a share. And this stock, it really presents one of the biggest questions in finance right now. Is it that, foundational, reliable, high-yield utility stock everyone wants? Or is this massive company actually maybe a value trap, sort of being slowly undermined by just intense competition?
Exactly. And our mission here is to dissect the operational realities, the financial strength, to understand why the price is where it is.
Right, because here's the hook, the thing that jumps out. The quantitative analysis pegs the intrinsic value somewhere between, get this, $45 and $55 per share, conservatively.
That is a huge potential discount. We're talking, what, 20% to 30%?
Yeah.
Well, and that gap, that's the focus. The market is clearly pricing in some serious qualitative risk, stuff that isn't fully captured into just the numbers. And we need to figure out what those risks really are.
Okay, so we've organized this deep dive into two main parts. Part one, we'll build the foundation, look at the core business, the big management shakeup, and the financials, the engine, really.
Right.
Then in part two, we'll shift to context, market sentiment, ownership issues, some pretty high-impact risks, and then our final conclusion. So let's start laying that groundwork. We begin with Chapter 1, Business Understanding.
Okay. So Verizon, fundamentally, it's a holding company. It provides connectivity, right? Anchored by massive subscription fees. And it operates in that classic U.S. wireless oligopoly, Verizon, AT&T, T-Mobile. But when you dig into how they actually make money, you see this really significant split.
And that split seems crucial for their future.
Yeah.
You've got the consumer group first. That's the big cash machine, right?
That's the one. It's like 76% of their revenue. Generated $102.9 billion in 2024. Huge number. This segment holds the core stuff. Postpaid mobile plans, prepaid, the Fios fiber network, and now, increasingly, fixed wireless access, or FWA. They've got scale, 115 million plus wireless connections mid-2025. It's mature, it's stable, and it's just essential for cash flow.
Okay, so that's the bedrock. But then on the other side, you have the business group. That's supposed to be the growth catalyst. Things like IoT, private 5G, serving almost all the Fortune 500 companies.
Right, that's the idea. But it only brought in about $29.5 billion in 2024, so much smaller, obviously.
22% of revenue, roughly.
Yeah. And here's, well, maybe the first real red flag we see in the business itself. The business group revenues actually declined by 2.0% in 2024.
Declined. Wow. So if your designated growth engine is actually shrinking.
It immediately raises questions, doesn't it? Big questions about where that top line growth is supposed to come from.
Okay, so if that traditional enterprise growth is stalling, maybe even shrinking, that makes their big push into fixed wireless access FWA incredibly important. Like their most crucial near-term lifeline.
Absolutely crucial. FWA is how they're trying to monetize that massive 5G infrastructure they spent years and billions building. They're essentially using 5G to compete directly in the home broadband market against traditional cable companies. It's a key strategy. And they've set a pretty aggressive target, too, 8 to 9 million FWA subscribers by 2028.
Aggressive indeed. But the competitive landscape, it looks terrifying from the outside. For decades, Verizon was like the undisputed king of reliability. That's why they could charge a premium.
They could, yeah.
But T-Mobile has just stormed ahead, right? Surpassing both VZ and AT&T in market share, something like 40% of the U.S. market now.
That's right. T-Mobile really changed the game.
So if the barriers to entry are supposedly insurmountable, how is T-Mobile doing that? How are they taking so much share?
Well, it suggests the market's perception of network reliability, while still important, has maybe eroded just enough for price to become a much bigger factor for many consumers. T-Mobile hammered that price message. Verizon's response hasn't really been to just slash prices across the board. They've pivoted more towards this perks platform.
Like bundling.
Exactly. Bundling services like streaming, maybe AI applications, things like that, trying to make the plan stickier. And apparently this platform is now generating about $2 billion a year. So it shows they're focused on keeping those high-value customers, not just by saying our network is best, but by adding value in other ways. Customization, bundling.
Okay. And just before you move on, it's probably worth just quickly mentioning those barriers to entry again. They are huge, right?
Oh, immense. You're talking tens of billions, literally, in capital spending every single year. Spectrum licenses, which are finite and cost a fortune, and just the sheer economies of scale you get from having, what was it, 146 million connections across the whole business. It's almost impossible for a new player to replicate that.
So the business isn't going away. The moat is real.
The cash flow feels pretty secure because of that moat, yeah.
But the growth,
Hmm.
that's the challenge.
Which brings us neatly to the operational, well, the big story that really defined 2025 for them. Let's formally transition now into Chapter 2, Management Evaluation.
Yeah, this was a big one. The story here really centers on that abrupt CEO transition back in October 2025. Hans Vestberg, who was really the architect of the whole 5G build-out, very engineering-focused,
Yeah.
he was suddenly replaced by Dan Schulman.
Dan Schulman, the former PayPal CEO, that's a very different background. Schulman's known more for customer focus, platforms. Vestberg was all infrastructure. That feels like a massive strategic shift.
Is
How did the market react to that shockwave?
not well.
Yeah.
The stock dropped almost 5% immediately. Just the suddenness of it all, it signaled deep investor dissatisfaction, maybe some board uncertainty about the direction Vestberg was taking them. But more importantly, maybe we can actually see the quantitative justification for this shakeup if we look at a key metric. Return on invested capital, or ROIC. ROIC. So basically, did all those tens of billions they poured into 5G actually pay off in terms of profit?
And the answer, increasingly, looked like no. That's the clearest sign, really, of a strategic problem. ROIC measures how efficiently you use your capital, right, your investments, to generate profit. Well, Verizon's ROIC peaked back in 2021 at around 11.5%. Pretty decent. But by 2024, it had slumped down to 8.6%.
Ouch.
Yeah. So despite throwing all that money, massive capital, at 5G, they just weren't generating proportional profit growth. Why? Well, market saturation, intense price competition. The investment simply wasn't paying off the way they'd hoped.
Okay, so the board brings in Schulman, presumably to fix that, to focus on monetization, maybe.
Yeah.
Now that they have new leadership, how are they talking about prioritizing their cash flow? Where's money going?
They seem pretty disciplined about it based on their guidance. First priority is still reinvestment. CapEx remains high, guided at $17.5 billion to $18.5 billion for 2025, mostly finishing the network build-out, expanding FWA.
Still a huge number.
Huge. Second, the dividend. This is absolutely central to the stock's appeal for many investors. They've increased it for 19 straight years, and it looks highly secure. The payout ratio is around 63% of earnings, which is quite sustainable, especially with the FCF they generate.
Okay, what else?
Third is debt reduction. They're actually prioritizing paying down debt over doing share buybacks right now. They want to hit a target leverage ratio, debt to EBITDA, of around 2.0x to 2.25x.
Sensible, given the amount of debt.
Very sensible. And then finally, way down the list is M&A. They're looking at things like the pending Frontier Communications acquisition, mainly to bolster their broadband assets, but it's not the top priority.
Okay, that sets the stage perfectly for the core numbers. Let's move right into Chapter 3. Financial analysis.
Right. So we talked about the lack of growth. The numbers really bear that out. Over 5 years, looking back from 2024, revenue was only about 5% higher than it was in 2020, just really slow. Last year's growth rate, 2024, was tiny, 0.61%. It really highlights how tough it is to grow in this mature market, a stagnant top line, basically.
Yeah, stagnant is the word. But as you said, that stagnation maybe masks some powerful profitability underneath. Their margins must be pretty good to handle everything.
They are quite resilient, actually, which reflects that network strength and, some pricing power still. The gross margin holds stable around 60.0%, very healthy. But the operating margin, which was 22.7% in 2024, that tends to bounce around a bit more. Why? Because they constantly have to pour money into marketing, promotions, defending their customer base against T-Mobile and AT&T. It's expensive.
That's right, the cost of competition. But the true superpower here, the thing that maybe underpins the whole bull case, is the free cash flow, right? FCF.
FCF is king for Verizon. That's what supports everything. The dividend, the debt payments, the investment. And it has recovered strongly after some weaker periods.
Yeah.
Management is guiding for a really robust $19.5 billion to $20.5 billion in free cash flow for 2025.
Wow, $20 billion.
Yeah, it's a massive number. And that easily covers the dividend, which costs them about $11.5 billion a year. Plenty of cushion. This is why people think of it as a utility stock. Even though it's tech, It's just an enormous, reliable cash generator, for now at least.
And that cash generation leads us straight to the valuation puzzle. Because the market seems to be treating VZ like, well, like a sick company. It's trading at a trailing 12-month PE ratio of only about 9.3x.
Which is incredibly low for a company of this scale and profitability, especially when you compare it to, say, T-Mobile, trading at a PE over 21x.
Less than half.
Yeah. And this huge discount is exactly what our analysis tried to quantify. When we ran an educational discounted cash flow model, a DCF, using that strong $20 billion FCF figure as a base, making some conservative assumptions about future growth, like only 1% terminal growth forever, and using an 8.0% weighted average cost of capital, the WACC, which is basically the hurdle rate reflecting their financing costs and risk.
Right.
We found the intrinsic value falls somewhere in the range of $45 to $55 per share.
45 to 55, compared to a price under 40. That's a powerful statement of potential undervaluation right there. Okay, before we jump into why the market seems to be ignoring that potential value, just a quick word for you listening. If you're finding this useful, remember to like and subscribe to Stock Analytics AI. Our members, it's just $4.99 a month, they get priority deep dives on specific tickers. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, you can always drop us a super thanks. Okay, back to Verizon. Now, let's really explore this massive disconnect. The quantitative valuation says one thing, the stock price says another. We're starting part 2 with Chapter 4, Market Sentiment. Okay, so if you look at Wall Street analysts, they actually, on average, seem to agree more with the valuation model than the market price. The consensus rating is something like a moderate buy hold, and the average one-year price target out there is $48.50. $48.50. That implies, what, over 20% upside from the current $39.85 price?
Exactly. So quantitatively, analysts tend to see it as cheap.
Yet, the stock itself, its actual trading pattern, tells a very different story, right?
Yeah.
A story more of fear and selling pressure.
Absolutely bearish, technically speaking. That current price, around $39.85, it's trading significantly below both its 50-day moving average, which is about $43.54, and also below its 200-day moving average, around $43.29. When a stock is below both those key technical levels, it indicates strong recent selling pressure. So it tells us that fundamental uncertainty, those qualitative risks we mentioned, they're really driving the price down right now, even while the models and many analysts say it should be higher.
Okay, so to understand that fear, that qualitative discount, we really have to look at who owns the company and, maybe more importantly, what the insiders are doing. Let's examine Chapter 5, Ownership Structure.
Right. Institutional ownership is very heavy, as you'd expect for a giant like Verizon. Mostly the big passive index funds, Vanguard, State Street, BlackRock. The top 25 institutions own over 42%. But the conviction, the belief we'd want to see from the people closest to the business, the insiders, it's just not there. In fact, it's the opposite.
Okay, what does the data show on insider conviction? This is often one of the biggest qualitative red flags you can find.
It's pretty shocking, actually. Insider ownership is incredibly low. Just 0.05% of the company's shares are held by insiders. Tiny fraction.
Wow, 0.05%.
Yeah. And maybe even more telling is their trading activity. Over the last 12 months covered by the analysis, insiders executed 23 sell transactions versus only 2 buy transactions. The net result was insiders selling nearly 400,000 shares.
Selling at these price levels.
Exactly. If the management team, the people who know the business inside and out, are consistently selling shares around $39, $40, it severely undermines the argument that the stock is significantly undervalued. It suggests they don't see huge upside from here, or at least they see risks.
That lack of conviction, yeah, that feeds directly into the risks the market seems to be pricing in so heavily. Let's move right into those risks now. Chapter 6. Risk assessment.
Okay, summing up the risks. We have some significant internal weaknesses first. Number 1, that colossal debt load we mentioned, over $148 billion. That's a huge anchor. Second, the revenue stagnation in the core business is just not growing much. And third, there's significant execution risk. You've got the abrupt new CEO transition, a shift in strategy, plus the complexities of integrating Frontier if that deal goes through. Lots of moving parts, lots that could go wrong.
And then you layer the macro environment on top of those internal issues, especially things like inflation and rising interest rates.
Yeah.
How do they play in?
They compound the problems, really. Inflation increases their operating costs, things like energy for the network, labor costs. And in this super competitive market, it's really hard for them to just pass those higher costs on to consumers without potentially losing market share. So that can squeeze margins.
Ah,
And the massive $148 billion debt load makes them extremely vulnerable to rising interest rates. Higher rates mean higher interest payments, which diverts more of that critical $20 billion free cash flow towards just servicing the debt, leaving less for reinvestment, dividends, or faster debt paydown.
Makes sense. But the analysis also highlighted one very specific, potentially high-impact geopolitical threat, something that could, totally derail the investment thesis. It tied back to capex and debt, too.
Yeah, this is a major unknown, a potential black swan, maybe. There was, at the time of analysis, a proposal floating around for a potential 100% tariff on Chinese goods. The suggested effective date was November 1st, 2025. Now, why does that matter so much to Verizon?
Network equipment.
Exactly. Critical telecom equipment, the stuff they need for network expansion, 5G upgrades, maintenance, a lot of it is heavily reliant on Chinese manufacturing or components from China. A 100% tariff would effectively double Verizon's costs for a huge chunk of their capital expenditures overnight.
Double their capex. They're spending $17, $18 billion a year now. Doubling that would just obliterate the free cash flow targets we talked about.
It would absolutely crush them. It strikes directly at the core investment thesis. It would drastically reduce that projected $20 billion FCF. It would threaten their debt reduction plans and potentially maybe even the security of the dividend, which is the main reason many income investors hold the stock in the first place. It's a massive potential shock.
Okay, that is a staggering systemic risk to consider. Let's try and bring all these threads together now in our final segment, Chapter 7. Conclusion.
Okay, so the investment case here really rests on a balancing act. The bull case, the reason to maybe buy at these levels, relies on, I'd say, three core strengths. First, that highly secure, massive $20 billion free cash flow engine. Second, the attractive dividend yield, around 7% at that price, which looks safe for now. And third, the clear growth trajectory offered by fixed wireless access, FWA. That's the main growth story. And the wild card is the new CEO, Dan Schulman. He's a potential catalyst if he can successfully pivot the company towards better monetization of the network.
Okay, that's the bull case. But the bear case sounds pretty formidable, too. What are the key points there?
The bear case is strong. First, the stagnant core business, especially the declining business segment. Second, the massive $148 billion debt load. Third, extremely high execution risk with the new CEO, the new strategy, and the frontier integration. Fourth, that huge red flag of consistent net selling by insiders. And finally, looming over everything is the specter of that potential geopolitical tariff shock, the China tariff.
So weighing those up.
We can confirm that the price at the time, $39.85, was significantly below our conservative estimated intrinsic value range of $45 to $55. The market price clearly reflects intense pessimism. It seems to be fully discounting, maybe even over-discounting, all those qualitative risks we just laid out. So yes, it looks cheap on paper, but you as an investor have to be comfortable underwriting that profound uncertainty and those significant risks. Cheap for a reason.
right. So what does this all really mean for you, the listener, maybe a long-term holder or someone considering it? Here's the final provocative thought we want to leave you with. Ultimately, the success of this stock, turning that potential value into actual returns, seems to hinge almost entirely on one thing. Can the new CEO, Dan Schulman, successfully pivot this huge organization? Can he shift it from what has always been, fundamentally, an engineering-first infrastructure-building company into a more nimble commercial and customer growth-focused entity? One that can finally extract significant profit from the tens and tens of billions already sunk into building that 5G network. That feels like the multi-billion-dollar question. Thank you for joining us on this deep dive into Verizon Communications. If you found this breakdown useful, please remember to subscribe to Stock Analytics AI members for priority analysis. We're continuing our coverage of the S&P 500 stocks in the coming months.
And just a reminder, please remember that this analysis was generated by an AI system. It's for educational and informational purposes only. It should absolutely not be considered financial advice. We strongly urge you to conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.